Inflation in China is easing right at the exact time where the economy could use a boost. That's what we're going to cover in this video. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. So the Wall Street Journal recently reported that inflation in China is looking to ease, which comes at the right time because the economy could really be using a boost right now. And essentially what they mean by that, and you can see here in their subheading, is that because there are lower risks from rising prices, the door is open for policy easing to help growth in the country. And what they mean by inflation reducing, you can see in this next slide, is that the Chinese factory gate inflation eased as consumer price growth slowed, giving Beijing room to stimulate growth when most major economies are looking to tighten policy to curb rising prices. So, I mean, that makes a lot of sense because we just hit 7.5% inflation in the US here. And so there's talks of a first 50 basis point increase and then two more increases for a full 100 basis point increase in the US. In Canada, the story is the same, where I think we just hit 5% inflation, and so we're looking to tighten here more than we're looking to boost the economy. It's not like the numbers are low in China. Let's be real here. The wholesale prices charged by manufacturers rose 9.1% in January. So that's not a small number, but it's down from the December figure of 10.3%. And the reason why that is because they're stating that it's the commodity prices declining, which is causing the producer price index to decline. So softening coal prices and steel prices are what helped lead the index down. Additionally, it looks like the Chinese authorities had reined in surging factory gate prices by ramping up the supply of commodities such as coal and cracking down on hoarding and speculation. I don't exactly know what they did, but I do know that when the Chinese electricity issue happened, where they started having blackouts, it was all hands on deck. All coal producers were up at 100% capacity to make sure that the nation got the amount of coal that it needed to fire its power plants so that the manufacturing could continue at high levels. And of course, on this next slide, you can see here that Bruce Pang, head of macro strategy research at China Renaissance Securities, did state that moderating producer price index inflation in China does help ease pressure on the manufacturers to pass on higher costs to consumers, which would be good news for the global inflation outlook. Of course, because our inflation in North America is largely driven on what the inflation is on the products being produced overseas, like in countries like China. And when you're looking at China's consumer inflation rates, you can see that Chinese consumer inflation has remained subdued, largely in part to lower pork prices and persistently weak domestic demand since the beginning of the pandemic. Now, this could actually be seen as a risk, and I'll go into that a little bit later. But you can see here that the price paid by consumers rose at a slower pace in January, with the consumer price index in China edging only up by 0.9% compared with 1.5% in December. So core consumer inflation, which strips out for food and energy costs, only rose by 1.2% in January, which in fact was unchanged from December. And of course, you guys may remember, if you've been following CPI growth in China, the highest it got to was in October, where it peaked at 2.3%. And then after that, it resumed its trend downwards. So exceptionally low numbers on the consumer inflation levels relative to what we're seeing in North America. Now, here's that risk that I was talking about, and I've mentioned on the channel before. China faces far bigger risks from a slowing economy than rising inflation. I've already discussed before that they have a slowing consumer and a rough real estate market, which could contribute to the slowing consumer. So with that said, what does the forecast look for inflation? Well, on the producer price index, the forecast is saying that it'll probably hit around 8.2% in the first quarter of 2022 before falling to 5.1%, 2.9%, and then 0.5% in the remaining quarters for 2022. So that's good news for North American consumers, at least, because their inflation isn't getting pushed by higher producer price inflation in China that would get passed on to us. Now, of course, the one risk for China is that rising geopolitical risks, such as the tension in Ukraine with Russia potentially invading, could push up industrial inflation, of course, with the price of commodities like oil. But the interesting thing is, if that really doesn't happen, even if central bankers in the US and other countries around the world, including Canada as well, tighten monetary policy, that doesn't necessarily mean that it's going to hold back China from further easing. China has already lowered 2 key interest rates after cutting the amount of cash that banks must hold in reserve twice since last summer. And people do believe that there's going to be another cut in June. So overall, this is good news, but I don't necessarily know how good news it is for overall consumption in the country because there's an overall slowdown, partly led by the real estate crisis that they are in. I really hope that they continue to manage this well. We don't know how this is going to roll out. Some people think it's going to be really bad for the economy overall. Others think that it might be a little bit more subdued. I'm in the camp where I hope that it's more subdued, but there's always a risk. So we'll see how this works out. Now, you guys may be aware, Alibaba is set to report on the 24th, which is this coming Thursday. And so I did a Q3 preview video, which if you haven't seen it, you can get to that video right here.